The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
All right, welcome back to another edition of the Daily Dots. Here on Monday, September 29th. Chase flying solo with you, and I think I will be tomorrow as well, and then I'll be away for a couple weeks. Today I have, of course, the markets, tiny bit of data, and there's a few things to talk about with some focus on the neutral rate of interest as that kind of finds itself back into some central banking headlines, at least of late, and I have a strong opinion there that I'll share. So we continue to be on a bit of a trapdoor, just thanks to systematic potential energy because of the over positioning, essentially, of systematic strategies. With that said, we continue to avoid falling into negative gamma. Kind of came in neutral today. S&P finished up 0.26, so still like you're standing on the trap door, but that valve is not opening until something pushes it there, which is going to be a 1-2% down day while in negative or neutral gamma to get us into negative, something like that. Something that forces the vol control people to sell or CTAs to sell or whatever the case may be. But for now, we're not in there, so we can keep grinding higher. But as soon as tomorrow, that whole thing could pop off and you could be down 2% and everyone's confused. And speaking of per tier 1 alpha, if you end up down 2%, you're talking over, I think, 50 billion in sales that would have to happen from vol control, their estimate. So S&P was 0.26, Q's up 0.46, small caps were up 0.12, equal weight up 0.33, Mag 7 up 0.5%. All world ex-US up 0.57, so beat all of the US indices. That was thanks to the dollar being down 0.25. So dollar looked like it was kind of coming out to play here recently. Now it's kind of right back to not looking that way. Bitcoin has had a solid weekend and a good day today, up about 2% today, back above 114,000. It's it really needs to go make a new high or it looks kind of bad. Though the real level of defense is 104, so you're still 10,000 above the level to me that makes it look really bad all of a sudden on the chart. So the chart can go either way near term. Oil had a brutal day, down about 4%. Let's see. Gold up another kind of 1.4. Silver up a little less than 1%. Platinum up another 2.2. Has been going straight up lately. Palladium actually down a little bit today, so at least both PGMs aren't going wildly straight up. Great day for copper, up 2.8%. Yields down about 2 basis points on the 2-year and about 3 on the 10 and 4 on the 30. This is important for the three things that I said: dollar down, oil down, rates down. So like that really removes a lot of pressure on the market. One of the reasons the market started to look a little squirrely last week was all of a sudden dollar, oil, and rates were moving higher. So today was a nice relief from that standpoint. And honestly, if you would have told me how much oil, rates, and dollar were down, I would have thought S&P could have done more than 0.26. So maybe it's getting a little tired. We're entering a buyout blackout period. I think a third of companies are already in their buyout blackout, and buyouts are a significant source of demand for equities. Obviously, so has, since April, May, systematic strategies have been a huge source of demand. So have buybacks. So now all of a sudden you don't really have either. It just makes you more vulnerable to something happening to the downside. Doesn't mean it will happen. You're just more vulnerable than you would be outside of the blackout period. And when vol control and all these systematic strategies have to add. But it will be important to remember at some point you're going to have a bunch of forced selling from CTAs, vol control, vol targeting strategies, all this systematic money that just has to sell whenever vol expands. When that stuff gets wiped out and you have a 10% drawdown or whatever, they all have to turn back around and buy it back eventually. So being too bearish whenever this stuff goes down is going to be just as bad of a choice as being too bullish while standing on a trapdoor. As far as the Max 7 stuff went, you had Apple down a little, Google down about 1%, Microsoft and Tesla up about 0.6. A solid day for NVIDIA, but it didn't put it in a new high, but it was up 2%. You had the ARC stuff. ARC was up 3.7. That's kind of been lately the concentration of where things are going. But and then you had Amazon up 1, Meta down a tiny bit, basically flat. Of note on the day, pretty, a solid day in the market. And you had Vol up another 1.5. Spot VIX up 5. There's been a persistent bid in protection. I don't know if it's just more people know what I'm talking about with the systematic stuff, and that's creating this bid, or what it is, but it's kind of been notable. Sometimes I take that as a big signal, like we're about to get some fireworks, but this has been going on for like 3 weeks now, so maybe not. I don't know. China was up about 1.6 with Chinese tech of about 1.9 today, so very, very solid on that front. The only data we got today was, we had Texas manufacturing that was bad as well, but we had pending home sales, which kind of leads the other home sales data, and it was solid, 5-month high. So that's good. You had really good new home sales last week, decent existing home sales. So these lower rates have helped the housing market. It's not good data yet, but it's stabilizing. It's better than it has been in the last year or whatever. So worth noting. Some of the stuff I wanted to touch on, Huawei is going to double the production next year of their best AI chip, the Ascend. So they ban NVIDIA chips for their tech companies. Next thing you know, Huawei's talking about breakthroughs they have, talking about doubling their chip manufacturing. So I think you're going to see more and more Chinese companies obviously go towards their domestic tech stack on things like chips, but also think, the BRICS countries of the world, the a lot of Asian countries, or even European countries, in some cases, are going to probably favor some of these chips, because knowing China, they'll catch up quicker than we expect on the quality side, and we know the price side will be good, and that can put real pressure on NVIDIA margins if they want to continue to compete globally. But that may be a multi-year story before it really matters. I couldn't get through a show without talking about more tariffs. We have apparently 100% tariffs on foreign movies, and then there's more threats of furniture tariffs. We have some specialized furniture tariffs, like this kind of furniture, that kind of furniture, but no like kind of blanket, like all the furniture gets a huge tariff thing. But that sounds like it might be happening in the future. We already have furniture inflation taking off, so that would get that much worse. I don't know if furniture is a strategic national security, commodity worth defending the production of, but bring it back. It will create some jobs in North Carolina and some other places for sure. But I don't know what it'll do for consumption more broadly. It's something to keep an eye on. That could be another contributor to some higher inflation, I think. And speaking of higher inflation, the thing I will spend the rest of my time on today, and it'll probably be pretty brief, is what's known as R-star, the neutral rate of interest. There's a lot of different nerdy ways to think about this, but just think of it as like, and it ties to not just the Fed's policy rate, but other things. But let's just think of it for this conversation as where the Fed's policy rate should be. Right now, the longer run neutral rate by the Fed, if you tally up everyone's vote on it, essentially, is 3%. Obviously, rates themselves are higher than that. They're still at 4. I guess technically 4 to 4.25, but we have a few people on the Fed board thinking that these, not to mention Secretary Bessent, that think that we're really restrictive right now at this 4% rate, that neutral is more like, in the 2s. If not low 2s, there are people that think it's no higher than it was 5-10 years ago. including important people, at the Fed. We had a speech today from John Williams, the second speech where he's talked about this here in the last couple of months. But um, it's notable to me on Stephen Meehan, especially because less than a year ago, so October 14th, it was like, so, 2-3 weeks before the election, he talked openly about the fact that in 2024, he was making the arguments that neutral is higher than the Fed thinks. The Fed was not as tight as they thought. That Treasury issuance policy was counteracting what Fed restriction there was, and that the reduced hiring rate was not indicative of problems with aggregate demand. These are all essentially arguments he has done a full 180 on since joining the Fed, or since joining the administration more accurately. So now he's arguing that the neutral rate of interest is falling and is really, really low. So he thinks we need another, like, whatever it is, 125. Yeah, 125 basis points worth of cuts just in the rest of this year, which, we have 3 months left. So talking about he went at 350 basis point cuts. To me, that's insane. And to me, John Williams' view that the neutral rate of interest hasn't really even gone up, insane. And I'll explain why I think R-star, or the neutral rate of interest, not only is it not 2, I don't think it's 3. Like, I think it might be in the 3s, up in the high 3s, maybe even 4, or the 4s. And the reasons for this, a lot of these models don't take into account a lot of, like, just frankly common sense stuff. Models leave things out and they make assumptions. Everything they leave out matters. Every assumption they make matters, especially the poor assumptions, right? So the reason I think this stuff's higher is, for one, we have higher fiscal. Like, having peacetime fiscal deficits, it's 7%, not normal. Now, one of Steve Meehan's viewpoints is like, oh, well, we're being pretty fiscally restrictive. We have this tariff income, like, deficits getting better. So that's going to be a drag, essentially. And to me, there's just no evidence to suggest that the deficit itself is going to come down. Maybe it's not going to be 9 like it would have been without tariff income or something, but it's still monumentally high versus all of recorded history in the United States. Like, we've never done this before outside of major wartime. So to me, that really doesn't hold up. So the higher fiscal, not to mention the fact that it creates its own feedback loop with high levels of debt. So high fiscal means higher rates, which means higher interest costs. And those interest costs become more debt, bigger deficits, so that it kind of feeds on itself. The more the deficit goes up, the more the interest income goes up. And then the more the interest income goes up, the more the deficit goes up. And you kind of get the idea. It's one of the reasons, I've talked a lot about the fiscal dominance, where you get to a point where no matter what inflation is, you got to lower rates because you can't afford not to. And we're not literally there, but clearly the president wants us to be there. People like Steve Meehan now, unlike a year ago, want us to be there. We'll just cut the rates because, we can't really afford the interest cost. Never mind the fact that inflation has been above target for 4 years and running, and is currently at 3 and rising. Another reason is global savings. This is one that I don't think enough people pay attention to. We really had this massive global savings boom and what people refer to as a glut in like the 90s and the 2000s. A lot of it was from Asia. Their savings rates are really high. Their growth was really high. That compounded and turned into a lot of savings. A lot of that was invested in the U.S. and it was invested in the treasuries. So we just always had cheap capital we could tap into, and you end up investing in things you probably shouldn't whenever you get cheap access to money, right? The problem is we've had a lot of demographic changes. We've had some of these emerging economies in places like Asia mature, where that savings rate is just naturally starts to come down some. Aging populations, instead of saving all their money and investing it, they have to actually start consuming that capital, and that changes things. And that's another big reason why I think the neutral rate is higher than it was, say, 10 years ago, and probably is higher 10 years from now than it is now. And that is, you have a lot of people retiring, so they exit the workforce, and instead of all their money from their employment finding its way into capital markets and lowering the cost of capital, they become capital consumers. Like they take their money out of their IRA to fund their lifestyle. And we get more and more of that every year, obviously, as this giant chunk of baby boomers, this huge generation retires and consumes their capital. Now, the market going up as much as it has helps them, run on that treadmill in a way that the capital isn't in a drawdown per se on a nominal basis. But point still remains. You have a huge number of humans that went from capital providers to capital consumers. And yes, millennials are also a pretty big generation, but we're not doing as well as they were at this point in their lives. So in some ways, our ability to be capital providers is just less. Like our ability to build wealth, to have really good wage gains has been less. So I think the aging population, just demographics in general, both globally and just in the US, lend to a higher, just baseline rate of inflation, and thus a higher neutral interest rate. And neutral means, some magical fairy dust level where you're not hurting or helping the economy. It's just like just right porridge, which obviously isn't a real thing. But another thing too is tighter immigration. I think it's pretty clear that wage cost, the cost of labor, which is a massive input into prices. If you have less supply of labor and even close to stable demand for labor, then you're going to have a higher cost of labor and thus more inflation. So with all that being said, those are some of the reasons I see the neutral rate of interest being higher than it was 10 years ago, and probably continuing to move that way. Are we going to get less fiscal? We probably aren't. Are we going to get a new global savings glut? I'm going to go with no. Is the aging population going to get younger? Definitely not. Now immigration could change because of political change or something, but for now, for the next 3 years, that's not probably going to get much better. And then are boomers going to stop retiring? Maybe if you blow up their IRA, but other than that, no. So to me, this is all kind of baked in the cake. Now, I think you can make the argument that, AI productivity could lead to some higher levels of unemployment and stuff that you could end up in a situation where, okay, well, we're fine now. It's like a deflationary supernova that comes from wild productivity gains from robots or whatever. Possible, but that's, pretty tough to make a forecast about, and definitely not a given, despite the market trying to price it like a given at the moment. And before I let you go, I want to read a section from The Great Demographic Reversal, which was written by Charles Goodhart and Manoj Pradhan, that I think helps capture this in a bigger picture way, in a more historical way that's sort of mind-blowing. And that it's a weird, almost like run-on sentence that I have here, but just stick with me. Combining these two factors, the rise of China, globalization, and the reincorporation of Eastern Europe into the world trading system, together with the demographic forces, the arrival of the baby boomers into the labor force, and the improvement in the dependency ratio, and that's like how many old people there are to take care of, together with a greater women's employment, produced the largest ever massive positive labor supply shock. The effective labor supply force for the world's advanced economy trading system more than doubled over the 27 years from 1991 to 2018. So if you think about these emerging economies as, largely driven by China, like you said, like they say here, women entering the labor force more, opening up Eastern Europe after the fall of the Soviet Union, these led to this massive labor supply shock. And labor supply shock obviously means cheaper labor, which means cheaper goods. That's why we offshored a bunch of this stuff to these places, because the labor was so cheap. But that's all unwinding. Obviously, the trade war is unwinding a lot of the globalization. All of these things make, and I didn't even mention tariffs in my higher neutral rate, and that obviously belongs, but you just unwinding a generational labor supply shock is another massive part of this. Just, it's such a big force that it's like so big you can't even see it. It's almost like the fish that says, what is water? Because we lived through that for 30 years. Like it it just became the water for us. And it's not like that was sort of a one-off miracle of demographics and geopolitics that is incredibly difficult to replicate. And the chances are labor costs will keep going up, not just here, but large, kind of everywhere, but Africa, because Africa is the only place that has significant population growth looking forward for the next 30 years. And even that, it may not be what we think it's going to be. But I just wanted to talk about the neutral rate of interest because I have seen 3 speeches on it from Fed folks in the last 2 weeks that made my head hurt. So I just wanted to spend a couple minutes on it today. But that's all for me today. Remember, it's jobs week. We'll have some jobs data as the week goes on. It does look like the odds of a government shutdown have jumped today. There was a big meeting between the GOP and the Democrats. I saw something right before I started recording. JD Vance said, yeah, it looks like we're headed for a shutdown. So I would assume we're at least going to shut down for, a couple of days or something. That may be why bond yields were down today, kind of starting to try to deal with that. I don't know. But I think I'll be back with you guys tomorrow for one last show before I try to get away for a couple weeks. But back tomorrow with more. Don't forget, you can download and subscribe, knowyourriskpodcast.com. And as always, check us out on YouTube and all the socials except for the ones we're not on, which is, I think, maybe only LinkedIn. All right, cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC-registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.